Major support for these programs is provided by Bank of America, Merrill Lynch, and Perfect Building Maintenance, New York Community Bank, All Nation Renovation, Kilroy Architectural Windows, New York's Window Company, Greenberg Traurig, LLP, M&T Bank. Additional support is provided by AVR Realty Company, LLC, Ackman Ziff Real Estate Group, LLC, Bingham McCutcheon, LLP, Briarwood Organization, Capital One Bank, C.B. Richard Ellis, James Orphanides, Centurion Holdings, Cushman & Wakefield, Dimes Savings Bank of Williamsburg, Douglaston Development, DDG Partners, Eastern Consolidated, Hal Fettner, Durst Fettner Residential, Friedman, LLP, Accountants and Advisors, Gemini Real Estate Advisors, LLC, Genova, Burns and Giantomasi, Grubb and Ellis, Investors Savings Bank, Jack Jaffa and Associates Real Estate Consultants, James D. Kuhn Real Estate Institute at Syracuse University, Madison Realty Capital, Massey Knackle Realty Services, Meridian Capital Group, Margolin Weiner and Evans, LLP, Certified Public Accountants and Business Advisors, Newmark Knight Frank, RAL Development Services, The Spandrel Group, LLC, Siami Development, SJP Properties, Site Comply, Sterling & Sterling, Stephen Napolitano, The Wickoff Group, Urban American.
In my 450th show, the final show of my 10th season, it is appropriate to bring back people who have been with me for 10 seasons. Friends, supporters, and really interesting characters. They're in the real estate business, they're in other businesses, but they have a pulse on what's happening in the real estate market. So today, my guests, to celebrate my 450th show and the final show of the 10th season include Jeffrey Levine, Chairman, CEO, Grand Poobah, Levine Builders, Douglaston Development. Scott Major, who once even played attorney, a tax attorney, my good friend who is the Chairman and CEO of Perfect Building Maintenance and Short Path. From the state of Israel, somebody who said, you know what, real estate is like baseball, everybody loves it. My good friend Ofer Yardeni, the co-founder and managing member of Stonehenge Partners. And last but not least, they call it Silver Cup. Some people think it was a bread place. It was a bread place. But one of the finest and best studios in New York and around the country is Silver Cup Studios. And I'm really fortunate to have Alan Suna, the CEO of Silver Cup Studios. But you're also in other business. You were in the real estate business with him for 30 years.
Yeah, we still are.
So
we don't do everything together, but we do a few things
together. Talk to us, because right now, besides operating Silver Cup Studios, you're also developing it's built. You have a condo in,
we have a condo
in Long Island City.
Yes.
What's happening there?
It's a fabulous project. It's not very big, but it's just a few blocks from the studio, so it was very easy for us to watch and manage. And but Jeff has seen the building. It came out great. We had sold quite a few units, and we had a lot of traffic in the last 2 weeks. We have a number of offers, and prices are doing very well. And we're very optimistic that we'll sell out soon.
So here's really the question. I really brought you together, besides the fact that you're good friends, to really give me your thoughts on how you look at the market today and how you looked at the market 10 years ago. Because unfortunately, we started the show 3 months after 9/11. It was November of 2001 when live from Shala's Kosher Restaurant, we had the Stoller Report at 11 o'clock at night. And if you didn't have your radio tuned to this side, you couldn't have heard the show. But it was an interesting time. How do you look at the market today? How do you see the market? I mean, as my friend Mr. Yardeni calls me Dr. Doom and Gloom, you know, and everything else, but we'll get him. How do you look at the market today?
I don't see it as doom and gloom, frankly, not even slightly.
Are we going to have a double dip?
No. You know, I mean, basically markets move up and down, so will you see wave motion? Sure, we always see wave motion. We never see straight lines. But a double dip that it goes like this and then drops again like this, and then like this and then drops again, not at all.
What happened in 2008? 2008, you don't remember that?
I remember it well.
Yeah, it wasn't a good year.
In 2008, in the aftermath of the financial collapse, we were in the midst of the Great Recession, and the good news is we survived the trauma. Yeah. We're still here doing business, and to some degree, while development is difficult to finance going forward because financing structures have changed drastically, our existing operating real estate is doing as well as ever. On the rental side, the residential rental side, where I have expertise, as Ofer said earlier, we're back to numbers of 06 and 07. The downturn, which in New York City was at probably the worst point, 20% of rents, 20% of condo sales prices, has been recaptured. Mm-hmm. And because of the lack of real estate construction financing, there's very little supply out there, and the demand is as strong as ever.
I want to ask somebody who's, you know, on the periphery in development, because he's not really in the real estate development, but somebody who has been investing in real estate for many years and who is the premier cleaning company of New York and around the country. How do you see the market, in the office market?
In the office market, things have gotten much better. I saw that turnaround probably about halfway through 2010. Vacancies have gone down, so the vacancy rates have gone down. And in our business, we generally discount the base and try to make our money on selling extra services to the tenants. So when space goes dark or tenants start cutting back, we take a hit. That has changed drastically from 2010 to now. The first quarter of 2011 is one of the best we've had in a long time. Landlords are renting their space up. It's not really our concern what the rents are, but they're renting their space up. And the tenants are buying more. So it's gotten a lot better.
And you?
So first, I would like to congratulate you for 10 amazing years. I remember starting at the restaurant and having great dinners. And I'm seeing you today and I'm seeing your show. And it's amazing. I have friends from around the world that are calling me and I'm asking me how about you and how well I know about you. So you did great. And I wish you another 10 or 15 years in an amazing show.
You know, thank God for, it is an interesting, because I catch my statistics, and recently on one of my articles in my shows, when you see people from England, India, Malaysia, India, you know, watching the show because of YouTube and iTunes, it really, you know, it's a phenomenon. And that's the fact that you have to bring great guests together.
So how do I see the market today? And I was shocked like everybody else after the collapse of Lehman, how the market collapsed and how the financing world shut down, and really everybody thought the end of the world is coming. And you know me quite well that I do not overreact when the market is going down, and I'm not overreacting when the market is high. But what I see for the last 3 months in our 18, 19 properties that we have in the city is tremendous growth in rents. We are achieving rents that we never achieved before. Chelsea and the Greenwich Village, we are achieving rents over $80, $85 a square foot. Or in the residential, I'm talking about studios over $3,000, one bedroom over $4,000, not necessary building with amenities and with a doorman. And we have never seen this kind of rents before 2008.
But part of that, I think, that's people. I mean, and Jeff and Alan both have developments. Jeff has one of the finest developments in Williamsburg, if not the finest, The Edge. But a lot of people are renting. People aren't buying.
I don't think that it's just about people are renting. First of all, just to let you know, I've been in this business for close to 20 years. We never did a condominium. And in 2009, we decided to do our first condominium.
So how many more are you going to do in 2011, 2012?
I cannot tell you how much I will do in 2011, 2012, but I want you to know that we sold all the units that we had available to sell. We started selling on Merit House, condos. It's Upper East Side, pre-war building with fireplaces that were going for $1,100 a square foot for Classic 6. And we ended the deal, the sale after a year at around $1,400, $1,500. We had Chinese buyers that bought the penthouse for $1,850, never saw the property, bought it from over the internet and was wired the money, and he paid over $1,800 a square foot. So the condo market, if you have a great product in a great location, you are going to sell it. And if you'll see that some of the prices that are getting today, if it's 15 Central Park West or the best location, they will get the best prices. But just a second, with respect to the rental, 40% of our leases, we rent for people who are coming to New York, first time comers to New York. These are people that are coming for jobs, students, and there is a huge movement towards people that want to live in New York. So if you will take 40% of our tenants that are coming here and our vacancy is not even 1%, we are really expecting in the next 18 months to have a huge spike in rents going just in one direction.
So we've already seen in the last 12 months.
We saw in the last 12, I would say in the last 6 months, we increased rents overall in our portfolio, I would say around 20%. And the 20% came from 8% of OP, 8% of concession, and we were able to increase base rent. So we are able to rent those units.
But here is the question that Jeff brought out.
Yes.
And I think Alan saw when he was financing the construction in Long Island City, and which Scott sees just in the general business. Things are good in the rentals and other markets, but the banks are still very cautious, correct?
Absolutely. The banks have to see these increases in place and sustaining themselves.
In place and no future projections.
Right
if
now,
you saw my show the week before.
Right now, the rents have increased. The new lease signings are at higher numbers, 20% higher than they were a year ago. But banks typically, for their financing purposes, certainly for development, look at trailing rather than progressing rents. So I think you're going to have these rents continuous for the next year or two, and you'll start to see higher loan to value for construction.
But for now, but you have much more equity in deals now than you had, pre-2008. And that's just the nature of the beast. So you have to just simply figure out how you're going to come up with the equity.
But I think that this will change too. I think that as banks are starting to compete on clients, and a year ago you were lucky to get a loan, then you were lucky enough to get 50 or 60%. We refinance a lot of our portfolio. I received calls yesterday from several institutions that want to enter to the market here and are willing to give 3.5% interest fixed for 5 years.
Here's the interesting situation with banks, and I talk to them all the time. What they're saying is they are competing for certain borrowers. They are not going. They want everyone, they're chasing certain deals. I mean, for example, there was a deal in Long Island City with, I think it was Rock Rose. They owned the land for free, a lot of money in the deal. Everybody sent the term sheet. There was this deal with the Gotham organization.
Studio City.
Studio City. I mean, where everybody. But if it's not an Ofer Yordeni, and if it's not a Scott Major, there are other people that we know in the business who were high-flying players. They can't get a loan if they tried, right? That's
true. That's true.
So Ofer, it's the survival of the fittest. The banks want to deal with people that they who don't really need their money.
But
in many aspects.
Banks, first of all, we all need the money. Second, we're not the only buyers in town. You have a lot of guys that are buying, and they will need financing, and the banks are going to lend to those individuals that are buying. There are plenty of banks that want to enter to the market. So I think that if you see the last transaction that happened in New York, you see that there are not prices that were bottom prices. They were top prices, and banks were willing
But I
to
think
lend.
you have to distinguish between stabilized loans
Yes.
and development loans.
Development loan is a
Stabilized
completely
loans,
different.
if somebody's putting down equity, people
Yes.
are going to pay. We just saw under a 4 cap on the Cube deal up on 72nd Street. If you go forward for development loans, they only want seasoned developers, who have earned their medals of honor, so to speak, coming through this recession and having stood up to the downturn.
Despite all of that, you still need to have a good balance sheet. They need to see that you're really solid, not that you just had a good track record. They do not want people that are, in their view, in today's world, over-leveraged.
Mm-hmm.
Debt-to-equity ratios are really important, even in the middle market lending area. We're seeing, particularly in the real estate services.
Right.
What do you see? Okay, Williamsburg is hot as hell. Long Island City, I think, is really doing well. It's really, you know, as we had you on the beginning of the season.
It's not as hot as hell. It's hot as purgatory. It's on its way to being hot as hell.
No. But what I'm saying is, how are we seeing the outer boroughs? How are we seeing Queens, the
Well,
Bronx?
I can tell you something very simply. Years ago, people might live in the bedroom communities of Brooklyn and Queens, Staten Island, Bronx, and travel to Manhattan.
He doesn't know what Staten Island
and
is. He's never been there.
And travel to Manhattan, be it the East Village, Soho, for their entertainment, their shopping, their pleasure. I see a reverse commute happening. I see people who live in Manhattan now taking the L train and now the water taxi to Williamsburg to partake in the amenities of retail and dining and cafes that exist over there. I see tourists coming out of the L train to enjoy what the new communities which appeal to the younger demographics who are making their housing and shelter decisions for these next 10 and 20 years.
Jeff is so on the mark, you know, and I'm not saying that because I love him, and I do, but we had to, I don't want to say chase out, we had to ask nicely to leave. We are apparently, in the studio side, we're on a bike tour, all right? We had 30 or 40 bikers that just pulled into our parking lot the other day, and all young people from all over the world. We have
bicycles?
On bicycles.
Okay,
and
not on Harleys.
No. Bicycles, the
thinking,
way people travel around in Amsterdam and other kinds of places. And we have a bunch of hotels which are far less expensive than Manhattan in Long Island City. And you know who the clientele is? It's all Europeans and other travelers that have come
So
in.
you mean the 14 hotels, the Reeve and the other ones with the rooftop in Long Island City are doing okay?
They're packed.
They might be packed, but it's all about pricing.
Yeah,
People are moving to Williamsburg or to his hotel because they
No, he
cannot
doesn't have a
afford,
hotel. He doesn't
or they
have a
cannot
hotel. Thank
afford
goodness.
to be in Manhattan.
No. Actually,
Generally speaking, that's the case. But the younger people, those people, Generation X, from 25 to 37 years of age, they are making the conscious decision to move to Williamsburg because it has the sort of fare that is attractive to them, whether it's Asian fusion, whether it's the music venues. That's where.
And they're also for low cost. Downtown Brooklyn. Okay, forget Williamsburg.
Okay.
Downtown Brooklyn, they had 1,955 new apartments. They leased them up.
Of course, because it shows you, because there is a lot of...
You want to be on 80 DeKalb Avenue?
No,
the only thing you can go to is Junior's?
Michael, it's very simple. We have had in the last 6 months or the last year a lot of people moving to the city because of new job, if it's financial, if it's health, if it's entertainment. Almost every industry are hiring right now. People do not have a place to find apartment. So when they don't have a place, they start to go to Brooklyn. It's not that we had suddenly 10% vacancy and Brooklyn and Williamsburg are full. It's because our rents are so high in the city and they need to find a place cheaper. In Williamsburg, you are getting between $45 to $50 a square foot.
You're getting over $50 a foot at the prime locations today.
The same place you will get in Manhattan, $80 a square foot.
You're mixing apples and pears because what Jeff is saying is still accurate. Young people, all right? Not all the people, not the people that are going to your building, but a lot of young people are making decisions to go to Long Island City, go to Williamsburg, even to Bushwick, East Williamsburg as they call it.
Bushwick has become very big.
Absolutely. And why do they want to be there? because they have the right kinds of bars, the right kinds of social life, the right kinds of restaurants for what those young people want.
I hear, unless one of us is living in illusion.
One of
us. Yes, because you're telling me it's like Manhattan, you have 27,000 restaurants. You can find, if you want Italian food, you can find a place.
That's the point. That's the point.
You don't
in
get
the
it.
Upper East Side,
yes,
you can have Italian Continental, you can have French Gourmet, you can have 5-star Michelin. In Williamsburg, the type of venues that appeal to these young people are the Asian fusion.
So they go to the meat market, they go to the...
no, it's not cool anymore.
This is in their home.
So you're defining cool now?
Yes. Yes, that's what we're trying to say to you.
Go there and see who's living there. These young people are not coming here. Yes, it is cheaper, unquestionably. But it's more appealing to them because of what it has to offer.
I agree that they are there. I've been there many times. But I'm saying to you, it's all about pricing. If you will try to raise the rent to $80 a square foot, will they stay?
Absolutely not.
Okay, so if they will not stay, I'm just explaining to you my proof. If you will take the same apartment and the same rent, they will not stay, and it's okay. Williamsburg is great, and those locations are great.
If I have to disagree.
But nobody wakes up in the morning and graduate from Wisconsin or from Wharton said, you know what, Mommy, when I will graduate from Wharton, I'm going to move to Williamsburg.
But let's say it's a quality of life decision.
It's a quality of life.
What you see happening in the prime residential buildings of Manhattan, similar to what transpired years ago to Milstein over at the Normandy, which they aptly named on 33rd Street the Dormandy. The college kids graduated from whatever universities they went to. They wanted to live in New York, as everybody does, and they shared apartments and they put up demising walls. The young people who are choosing to stay in Manhattan, whether it be in Chelsea or Murray Hill, they're coming into a 2-bedroom, they're putting up a partition, illegal or otherwise, in the living room. 3 people are sharing a $4,000 a month rent, and they're living there, but they move to the other areas in the boroughs, and they can live in a much grander way for the same price of sharing apartments in Manhattan. And that's what you're saying.
You know what? This conversation is going off track, and I'm going to tell you why it's going off track. Ofer, in all fairness, I've heard you speak before, you knock everywhere other than Manhattan. And it's just what you do. It's okay.
But it's
hold
not
it.
me.
Ofer,
if you look at the entire universe,
Ofer,
if you look at the entire universe.
Let me finish. I'm not interested in the entire universe. Michael asked a question. What's happening in the other boroughs other than Manhattan? All right? It's the question that he asked.
You're taking it personally.
No, you know what? In certain
he's
regards,
trying to say...
I'm trying to say there's another world in New
Absolutely.
York City that has a bigger population than the island of Manhattan, that is vibrant and living and doing...
I'm not disagreeing with you.
Well, you appear to be.
Stores.
I'm not.
I mean, people live these places.
Absolutely, they're great places, but it's all about
This is
It's
like
not
reality
about
TV
price.
here. Look
This
at
is
this.
not about... It's not... You know what? You can say what you will. It's not all about price. Price has a factor. There's a lot of things that factor into it. It's not just...
Why don't we say this? Given the same price point, they would choose Williamsburg, Long Island City.
They won't
and
go...
ultimately, Greenpoint, I believe ultimately because of the zoning, because of the tax abatement, because of the subway transportation, and because of the water taxi, you ultimately will see the future development of the city of New York with this younger generation on that East River of Brooklyn and Queens.
And the richness of New York City in the long term comes from it being a 5-borough city, not from a 1-island city.
And you know what? We talk about Manhattan, but I haven't heard anybody talk about Lower Manhattan, which is really growing. 10 million square feet of office space, 650,000 square feet of retail over there. You know, lots of hotels. I mean, there's a lot of good things happening in Lower Manhattan that people want.
And residential development as well.
Right. And you know, magically, it's less expensive than certain other neighborhoods.
Less expensive.
But you know what? It's
commercial rents are still trying to break $30 a square foot.
And you clean a lot of...
higher than that. It's higher.
No, on the B buildings.
Yeah.
In the B buildings and C buildings in Lower Manhattan, they can't get $30 a foot. The A buildings are a different category. It's a different market. But Lower Manhattan is really, it's becoming vibrant. There are things happening. And, you know, with regard to something that you brought up, there is somebody who works at CUNY TV, one of our younger executives, who was living in Brooklyn Heights. And I remember he came to me because he knew that I knew Jeff, and he wanted to move to Williamsburg. And he loves Williamsburg. And downtown, he wasn't in downtown Brooklyn, he was in Brooklyn Heights, which is one of the nicest neighborhoods in Brooklyn.
Well, there's another exciting alternative neighborhood that's evolving today as we speak, As you know, the High Line just opened up the second leg, which takes you from 23rd Street all the way down
Is it
to
next
30th
to
Street.
the Ohm?
Well, I happen to have built a
next to the Ohm,
wonderful
but
luxury 80-20 apartment house over there, and the combination of rents improving generally, the neighborhood evolving, not only with the High Line, but with everything that's happening in the Hudson Yards area, with the 7 train being completed literally within a year now. That part of town, because of the zoning again, because of all of the pieces that are put into play by the city's administration, by the private sector, is getting ready to explode.
I mean, Dennis Friedrich was on my show. He said to me that Brookfield is going to break ground in a couple of months on 31st and 9th Avenue, and they're going to build 4 buildings for close to 8 million square feet. So, you know, you look at this, and I remember when you built the Ohm, and when you walk down on 37th Street where there are all these Rock Rose buildings or whatever, the TF buildings, where there's nothing. And now, you know, Arc Restaurants is opening up a big restaurant in one of the places. I mean, the world has changed. I mean, look at, you know, the Duane Reads today. The Duane Reads are really mini supermarkets. They're mini markets. They have a 4,000 square foot place. You know, the world has gotten better in that market.
But another thing, just going back to residential for a second, you know, in making New York a rich city, and I'm not just talking about dollars, it requires not just these people that are coming in for their first jobs and what have you. We need families to stay here and people to go to school. And
that's the biggest problem.
But let me tell you, we just sold a couple of apartments well north in you know, $1.25 million and what have you, to families. People that are having children and they want to be in New York. They don't want to go out to Long Island. They don't want to go to Westchester. They don't want to go to New Jersey. But they want to live in a transportation-rich area, which is Long Island City, so the mother and the father can get to work. They can have a backyard. In some of the cases, we have backyards.
Can I ask a simple question? The two of you, when you built on 116th Street, you were pioneers. Nobody was building up in Harlem over there. I mean, and look at the money that these people who bought units.
Well, the same rules of thumb applied in Harlem that apply in some of these other borough locations. You had great transportation, you had great retail amenities. Until you had the zoning and until you had the will to finance development in those areas, it didn't happen. And fortunately, HPD and the city's administration helped with subsidy money for limited equity co-ops, and that was the linchpin.
You know, and Jeff will tell you, or I'll tell you, know, basically the original plan there was just for retail, and we said no, we need residential as well, and it worked out wonderfully.
I am so happy that you're all here to celebrate my 450th show, the end of the 10th season, and I couldn't have had it much better by having you guys here. I'd like to thank Jeff Levine, Scott Major, Ophir Denny, and Alan Suna. See you in September.
Major support for these programs is provided by Bank of America, Merrill Lynch, and Perfect Building Maintenance, New York Community Bank, All Nation Renovation, Kilroy Architectural Windows, New York's Window Company, Greenberg Traurig, LLP, M&T Bank. Additional support is provided by AVR Realty Company, LLC, Ackman Ziff Real Estate Group, LLC, Bingham McCutcheon, LLP, Briarwood Organization, Capital One Bank, C.B. Richard Ellis, James Orphanides, Centurion Holdings, Cushman & Wakefield, Dimes Savings Bank of Williamsburg, Douglaston Development, DDG Partners, Eastern Consolidated, Hal Fettner, Durst Fettner Residential, Friedman, LLP, Accountants and Advisors, Gemini Real Estate Advisors, LLC, Genova, Burns and Giantomasi, Grubb and Ellis, Investors Savings Bank, Jack Jaffa and Associates Real Estate Consultants, James D. Kuhn Real Estate Institute at Syracuse University, Madison Realty Capital, Massey Knackle Realty Services, Meridian Capital Group, Margolin Weiner and Evans, LLP, Certified Public Accountants and Business Advisors, Newmark Knight Frank, RAL Development Services, The Spandrel Group, LLC, Siami Development, SJP Properties, Site Comply, Sterling & Sterling, Stephen Napolitano, The Wickoff Group, Urban American.